Good afternoon and welcome to the Thursday, January 27th Sheriff's Office Retirement Plan Board of Trustees meeting here in the Chesapeake Building in Leonardtown, Maryland. I'm David Weiskopf, the chair. And first, I'd like to do the roll call. Sitting to my far left.
Jeanette Cudmore, CFO.
John Walters, citizen member.
Catherine Pratson, Plan Administrator.
Thank you, and I will ask for the approval of the January 27th, 2022 meeting agenda.
So moved.
Second.
All in favor, vote aye. Aye. Ayes have it. Motion approved. And next, I will ask for the approval of the November 18th, 2021 meeting minutes.
So moved.
Second.
All those in favor, please vote aye.
Aye.
Ayes have it. Motion carries. Next is moving right along, new business by Mr. Wing.
Thank you, Mr. Weiskopf, and good afternoon, everyone. It's great to see you all again, and we're a little bit deep into January here, but Happy New Year. You can see we have a number of items on the agenda today. The meat of the discussion will follow suit from our meeting at this time last year. So at that time, if you recall, we took a look under the hood, essentially, of the equity allocations, the fixed income allocations, and compared them to the current benchmarks per the previous investment policy statement. It's really an exercise to, again, take a look under the hood. Are there any tilts or bets away from the benchmarks, material ones, and then we made recommendations as appropriate. And as you all know, we have a new investment policy statement in place as of 1/1 this year. So given some of the benchmarks are different now within fixed income and equities, thought it'd be prudent to run through a similar exercise. So as you can see on the agenda, we'll start within fixed income. And specifically, if you'd please turn to page 4, so you can grab the Exhibit 1 tab, flip that over, flip past the agenda page there, and we'll start on page 4, where it says fixed income policy change up at the top. So before we jump into the meat of the discussion here, for quick context, I wanted to note how the benchmark changed. So you can see up top, the previous benchmark was a mix of a number of different indices there. So about 43% of the fixed income benchmark was to the Barclays Aggregate Bond Index. That is a index of the broad U.S. investment grade bond market, including treasuries, mortgage-backed securities, high-quality investment-grade corporates, all investment-grade bonds. You also had 3 different slices to a few different areas, namely the Barclays TIPS Index, which includes Treasury inflation-protected securities, the Barclays High Yield Bond Index, which is sub-investment-grade debt, so below investment-grade. Think of that as the debt issued by more speculative grade companies, maybe smaller companies have higher leverage on their balance sheets. And then finally, the 19% to the Citigroup World Broad Investment Grade Index. So investment grade securities, not just in the US, but across the globe. So that's where we were. The new benchmark, as you can see below that, is just 100% to the Barclays aggregate, right? So we've simplified things, and we're using a benchmark now that comprises, again, just the U.S. fixed income investment grade universe. And before we move ahead to page 5, just a quick overview of the managers that are in the fund now. So there's 3 managers. One is Delaware Diversified Income Fund, a fund also actually used in the LOSAP and not the LOSAP, but the OPEB fund for you all on that committee. It's what's called a Core Plus fund. So the vast majority of their investments will be in investment grade bonds. But when I say plus, that means, a small allocation for Delaware, usually in the neighborhood of 10 to 12% to plus sectors. In other words, high yield bonds are below investment grade. The second manager is Lord Abbett, a short duration manager. So they tend to operate with bonds that have 1 to 3 year maturities. Again, predominantly in investment grade, but also a small slice to sub-investment grade bonds like high yield. Now, the third is a really different animal, the Loomis Sayles Bond Fund, and I'll give you much more color on it on the next page. But they tend to hold much more of an allocation to sub-investment grade debt. And per the previous benchmark, since 20% was allocated to high yield bonds, it was appropriate to hold the fund. But now that we're using a benchmark of pure investment grade bonds, I think it'd be prudent to do a review of that and for the board to consider potential changes due directly to what I've outlined on page 5 around the investment strategy of that fund. And the key takeaways there are really the second and third bullet points. So the fund itself may hold up to 35% of assets in below investment grade debt. So think of it more as a higher octane, more aggressive type of fixed income strategy. And more to that point, and I bolded this up because it's the key takeaway there at the bottom of page 5, it can also hold up to 20% of its assets in equity securities. So it's labeled obviously as a Loomis Sayles bond fund, but not only can it invest in really the broad spectrum of fixed income, but it can and does in fact hold equity securities. So when we think about fixed income and we ran through the dynamics of asset allocation and sort of the roles in the portfolio that we want various asset classes to play, with fixed income, we want it there for protection, right? We want to know that when equities sell off or have a meaningful decline, we could use the relative gains in fixed income for maybe benefit payments, expenses, liquidity needs, or in a perfect world, to rebalance back into equities when they become cheap. So we want a sizable allocation of fixed income, but we want to know it's sort of quote unquote pure, that it's going to play that role and we're going to be able to do just in fact that. So when equities sell off, we can use it for rebalancing purposes to buy cheap after equities decline. Yes, sir?
How given what's it, excuse me, down inside this, how did it escape having a plus label attached to it?
It's a fund that's been around for, I want to say, I have this on a previous page, probably about 35 or 40 years. That was the initial label. So it says Loomis Sayles Bond Fund. They have another product that I'll talk about shortly that's Core Plus, but it's actually much less aggressive than this bond approach. So it's really, the initial label and perhaps marketing out of Loomis back in the day, but that's just how they chose to name the respective funds.
Thank you.
You're welcome. So on pages 6 and 7, I want to talk about a couple of managers at a very high level qualitative perspective and then work through some of the quantitative characteristics. So given the broad outline as I just overlaid it, you may have inferred that I think it'd be prudent to consider another option other than the Loomis Sayles Bond Fund. So on page 6 here, as you work your way from left to right, you see 4 managers there. The third one is the current fund, the Loomis Sayles Bond Fund. And there are 3 others, 2 active managers and 1 index fund. And if you think about it from a risk spectrum, the second one there, the Fidelity U.S. Bond Index Fund, that's just tracking the Barclays Aggregate Bond Index. So it's all investment grade bonds tracking the characteristics, and it would be the most conservative approach since it has no allocation to those plus sectors or high yield debt. As you work your way from left to right, sort of from conservative to more aggressive, after Fidelity would be that first option there, Baird Core Plus. They're more of what I'd call a Core Plus light manager. They will hold some in the plus sectors like high yield, but much less of an allocation than many of their peers, as I'll show you shortly. They typically limit it to about 5%. And then all the way to the right there, the strategy I mentioned a second ago, Loomis Sayles Core Plus Bond Fund, similar to Baird, a little bit more aggressive, but probably more akin to the Delaware Diversified Income Fund that's currently in the fund in the way of the characteristics and exposures, particularly to those plus sectors and high yield. So 2 main takeaways on page 6. First, the strategy inceptions in that first darker, call it brown row there. All of these funds have been around for multiple decades, so they are consistent with the new requirements of the investment policy statement for being around for at a minimum 7 years. And then all the way at the bottom, from an expense perspective, you can see as you work your way from left to right there, Baird is about half the cost of the current Loomis fund at just 30 basis points. Using an index fund would be the cheapest solution there. You see Fidelity at 2.5. The current fund, Loomis Sayles Bond, at about 60 basis points, and their Core Plus bond product all the way to the right at 38 basis points. So if the board does decide to make a change here, it would be cost effective for the fund itself as a whole. Now on page 7, just to give you more color around some of the information I had already laid out, again, from a qualitative perspective, there's some broad language around each strategy, but I've highlighted what we feel are the most important takeaways. So if you look at Baird, again, in the highlighting portion of that second line, we do consider them a moderate risk, aggressive plus, or excuse me, aggregate plus strategy, again, sort of core plus light, given the fact that they tend to hold only 0 to 5% in high yield bonds. The other key takeaway for them in that second line there is they tend to maintain a neutral duration. So we talked a lot about that last year within fixed income. So they don't make interest rate bets. That's really one of the hardest things to do in investing, although many managers try to do it, usually fruitlessly. But they recognize that it's very hard to do. So they don't try to add value by making interest rate bets relative to the market. What they do focus on is security selection. And what again, to reiterate it, you can see highlighted below that in the fourth line, they tend to only hold about 0 to 5% in high yield bonds or that plus sector. You can see Fidelity below that, again, a shorter description because as it's highlighted, very simple strategy, right? It aims to replicate the characteristics of that aggregate bond index. So it's all US investment grade bonds. Below that, Loomis Sales Bond Fund, again, the current fund, you see it's a multi-sector bond strategy, and as I outlined a minute ago and further highlights below, may invest up to 20% in equity, which it can and does do, and then may invest up to 35% in sub-investment grade bonds, again, things like high yield bonds, bank loans, emerging market debt, and again, it can and does do that. And then finally, Loomis Sales Core Plus Bond, again, key takeaway, what I've highlighted, holds plus sectors, but it's relatively conservative, not just to the Loomis Sales Bond Fund, but to many of its peers too. But here, considering the options under consideration, we would refer to it as slightly more aggressive than Baird, but much less aggressive than the current fund, that Loomis Sales Bond Fund. So with that said, that's the qualitative overview. Let me pause to see if there are any questions before I continue.
If I may.
Yes, sir.
Up under Baird.
Yes.
I think somebody lapsed into broker speak up there in that paragraph. So for the record, would you help us understand CMBS and RMBS?
Yes,
And what they do or don't do?
Absolutely. So CMBS is an acronym for commercial mortgage-backed securities. So securitized debt backed, secured by commercial properties. And then below that, let me find my place, non-agency RMBS. So that's residential mortgage-backed securities that aren't backed by agencies, being Fannie Mae and Freddie Mac. So they don't have that implicit government guarantee. The residential mortgage-backed securities issued by other firms, again, non-agencies that don't have that implicit federal government guarantee. So they're a little bit more aggressive than the RMBS or residential mortgage-backed securities that are backed by Fannie Mae and Freddie Mac.
So what would be the purpose then of salting a bond fund with either or both of those?
Well, there are securitized assets within the aggregate bond index. In other words, mortgage-backed securities. CMBS or commercial mortgage-backed securities are a very, very small piece of it. So they tend to hold, it's not an off-benchmark allocation, but they tend to focus a little bit more on that area than relative to the benchmark. And the non-agency mortgage-backed securities, that's usually because since they don't have that implicit guarantee, then technically they are a little bit more riskier than that's backed by Fannie Mae and Freddie Mac. So essentially they're trying to pick up a little additional yield, enhance the return a little bit by using those allocations.
Okay, thank you.
You're welcome, sir.
Pat, can I ask a question, please?
Of course.
Are there any securities in either of the core bond and the Baird? Would they hold securities, equities?
Oh, no, I'm sorry. No, the only funds here, the only fund, that would hold equities would be the Loomis Sales Bond Fund, the current one. The rest of them are all fixed income and importantly, cash bonds, meaning no derivatives, which is also consistent with the current IPS that prohibits derivatives.
And would that include municipal bonds? Municipal?
So municipal bonds aren't in the aggregate bond index. From time to time, the managers may include small allocation to them depending on relative valuations, but it's not a part of their core approach. It would be more of, say, a tactical, if you will, allocation depending on valuations.
Okay.
Okay, great. So if we can skip ahead to page 8, I really want to get into the quantitative overview here. And in the next couple pages, I think it'll be a good, sort of foundation to when we get the historical returns. Again, context for how these managers have driven the returns over time. So there's a lot of data on page 8. But I've boxed up what we feel are the most important takeaways, namely the first there in the third column, yield to worst. And you can see that there's a pretty decent divergence between the yield and the various funds. So if you start with Baird, you can see it's just 1.8%, which is slightly higher than Fidelity. Again, that's consistent since they usually just hold a small component of high yield debt. But then when you get down to the Loomis Sayles Bond Fund, at 2.8%, almost double the index, and then Loomis Sayles Core Plus Bond, about 50% more than the index. So when you see a higher yield within fixed income, it just means that the managers are taking more risk. Or in other words, investing more in corporate bonds relative to treasuries or holding sub-investment grade debt because those bonds have higher yields. Investors demand higher yields to be compensated for the additional risk, the credit risk in those bonds and the potential default of those bonds. And really, you can see that, or what's driving those relative yields all the way to the right, where we have the box of the average quality of the respective funds. So the safest quality or average quality would be AAA. So you can see Baird up there is at A+, Fidelity at AA+, so having 2 A's over the 1 is indicative of higher quality, and obviously Fidelity there is in line with the benchmark at the bottom. But then you see Loomis Sayles Bond is BBB negative. That is the last rung of investment grade before you fall into sub-investment grade. And then Loomis Sayles Core Plus Bond below that at A, again, a little bit lower than Baird at A+. So you can see things that usually goes with those letters. The more letters, the higher quality. And then if you see a plus, it's indicative of higher quality, and a negative of lower quality. So again, the average quality is consistent with what you would expect given those yields. And that average is driven by page 9 specifically, where you see all the way to the right where we boxed up the below BBB. So those are the respective allocations to below investment grade debt for the managers. And again, Baird is in that darker blue to the left, so just about a 4% allocation right now. None for Fidelity because, again, it's investment grade bonds. You see Loomis there at 40%. Now you may say, I thought you just told me they can only hold 35%, but this is of the fixed income. Right, so it doesn't include the equity. So in other words, if we assume they're holding 20% equity and half of the money's in below investment grade, then for the total fund, 80% times the 40% leaves them at 32. So they're within that. But within the fixed income, it's very, very high. And then to the right there, the Loomis Sayles Core Plus Bond Fund, more than half lower than the Loomis Bond Fund, but maybe about 3 times higher than Baird. So again, just a breakdown of the credit quality buckets and what's driving that average credit quality that I showed on page 8.
If we
Yes,
go
sir.
back to page 8 for a second,
Yes, sir.
would you unpack the word worst?
Sure. So typically when investors think about bonds, you think about yield to maturity, right? So when that bond matures. However, a lot of bonds can be called by those who issue the bonds. So if it's say an opportune market environment for them to refinance the bonds. So yield to worst just means that if those investors do end up calling those bonds when they can, then this is the calculation. So this is sort of, think about it, the lowest yield you can expect. If they didn't call the bonds and we were using yield to maturity, then it would be slightly higher. But the worst just meaning the lowest you can expect if they do call the bonds and refinance them at lower rates.
Like the worst case scenario.
Right.
Right.
And since there's probably a bunch of early call provisions in the total holdings, what is that 1.7, for example, in Fidelity? Is that the average of all of the?
It'd be weighted average.
Okay.
Yes, sir. Yes, sir. So any really number, when you look from yield to worst, and then work your way from left to right, that's a weighted average of all the individual securities in each respective fund. Okay, so let's move to page 10. And I thought that context around sort of the credit quality and the yield would be helpful as we look at the historical record. So this data is as of December. The top chart is just showing returns for each of the respective funds over those respective periods. But I think the bottom table is probably a little bit more digestible. It's the same information as the chart above, but just showing you the specific numbers. So we're showing 4 time periods here, 3, 5, 7, 10 years again as of the end of last year. And in each of those buckets, not just the return, which are net of fees, but also the standard deviation or the volatility of the funds. So if you look at the short and intermediate term, specifically 3, 5, and 7 years, there's not too much differentiation between the active managers. However, as you'll note, everything is in yellow, which again illustrates that they've outperformed the Barclays aggregate. The most important takeaway is if you look at that 10-year number and look at the returns specifically in isolation, and then we'll break them down a little bit further here, you could see Baird returned 3.9% net of fees, so that was about a percentage point annualized higher than the benchmark, and then obviously Fidelity, since it's tracking the benchmark. The Loomis Sayles Bond Fund was at 4.8, and then Loomis Sayles Core Plus at 4.3. So in isolation, obviously, Loomis Sayles Bond Fund or the current investment has done the best, but it's also important to consider the path in getting there. So that's really the next line here, to the line over to the right under 10-year, the standard deviation or the volatility of the returns. So if you look at Baird, their volatility was, just a shade higher than Fidelity, which essentially matches the benchmark, and they've delivered about a percentage point higher in annualized returns. And if you contrast that with the Loomis Bond Fund that's showing the best return, that volatility is almost double the index. So in other words, those bets that I spoke to earlier have really driven a lot of risk within that fund, which is what we would expect when you're holding equities and holding a lot in sub-investment grade. And then Loomis Sayles Core Plus below that, even though, again, they've done better than, say, Baird at 4.3, they're proportionally, higher return at about, 10 to 12% has come with a volatility that's probably about 15 to 18% higher. So when we think about the returns from a risk-adjusted perspective, Baird is really number one there, followed by Loomis Sayles Core Plus, and then Loomis Sayles, the bond fund, is actually behind the index itself. So even though they've generated the highest returns, the path over time has been very volatile. And page 11, I think, is really instructive or illustrate that point nicely when you look at the calendar year returns. And I boxed up 3 of them here, but I want to speak to 2021 as well. So if you look at those numbers in 2021, the 5th bar there, the black one, is the index itself. So last year, the aggregate bond index actually posted just its 4th calendar year negative return since 1976. Now, when you look at the other options outside Loomis Sayles, they were generally around that. The actives were a little bit better. Again, what we would expect since they're not making huge bets. But then you see the green bar, Loomis Sayles, well ahead of the benchmark. Well, why was that? Equities were up 25 to 30% last year, and holding an allocation to equities was very helpful for them on a relative basis. But if you compare that with 2020, again, which was a decent year for the markets as a whole, but as you know, the path was incredibly volatile. So in Q1 of 2020, when equity markets sold off to the tune of 25% or so, the Loomis Sayles Bond Fund was actually down 12% during that quarter, where the rest of the managers actually were in the black. So then digging themselves such a big hole, even though they then outperformed in Q2, Q3, and Q4 and got themselves back into positive territory, having to dig out of such a big hole didn't allow them to keep pace nearly with the other managers. And then a similar story for 2018 and 2015, both challenging years for equity markets. You can see the active managers a little bit below the respective benchmarks, which we would expect given they're slightly more aggressive. But then Loomis and Green there well behind the benchmark. So again, indicative of number one, the path of how they've gotten to the superior absolute return over time. But number two, also taking into consideration, again, what's the role we want fixed income to play in the portfolio, more certainty than anything else. So on page 12, before I sum things up here, I did want to show one other quick thing I thought would be helpful. So
Excuse me.
again, this is the respective results for the various managers. Another look at a risk-adjusted return, but not taking it into account their absolute volatility, but essentially their volatility relative to the benchmark. So this is what's called an information ratio, and I'll get into the granularity in a second, but essentially it's a measure of consistency. A lot of investors think about it as manager skill. So what it essentially boils down to is if you're making a small number of bets relative to the benchmark, but they consistently work for you over time, then you'll have a higher number or higher information ratio. Again, you're not deviating from the benchmark terribly, but when you do deviate, it tends to consistently work in your favor. So if you look at that 10-year number, again, hearkening back to the returns I showed earlier where Baird was just a percentage point ahead of the benchmark and not as well as both Loomis products, since their volatility was almost in line with the benchmark, they don't make a ton of huge bets, but it tends to pay off consistently over the years. But then as you look from left to right there, Fidelity will be a little low or lower across the board, and the reason behind that is even though they're matching the benchmark, there's a fee. So they'll be slightly below it by about 2.5 basis points over the years just because of that fee. And then for the other managers, you could see Loomis Sales Bond, again, even though they have the best return, they have the lowest information ratio because of how much they deviate from that benchmark. And they're in lighter blue, the Core Plus Loomis product, kind of in the middle of the two. So they're taking less bets than the Loomis Sales Bond Fund, but those bets don't pay off as consistently as Baird. Now, I know that's a little bit of a different concept. I'm going to pause again before I wrap things up on page 13 to see if there are any comments or questions around that. Okay. So on page 13, hopefully I've articulated this, but I always think it's helpful when we're making a proposal for you to consider just to sum things up around the pros and cons. So when you look at Baird, we'll start off with the pros, again, as we showed, strong long-term returns, best long-term risk-adjusted returns, and low fees. So what we're saying not lowest here because it's more expensive than an index fund, but it's a lower approach than the two other managers under consideration. The con, and admittedly I'm nitpicking here because it's been around for a couple decades, but it does have about a 10 or 15-year shorter track record than the two Loomis funds. Now for the Fidelity Fund, again, the index fund, the biggest pro is that downside protection. Again, if you look at those calendar year returns in challenging equity market environments, since it's all investment grade bonds, which tend to outperform riskier bonds, then for the total fund perspective, it will provide more downside protection, and again, it has the lowest fees. The one con to the right is there's no opportunity for value add, or in essence, for them to outperform the benchmark because it's just an index fund. Loomis Sales Bond Fund, the pro, again, strongest long-term returns, but the con, the highest fees, as I showed, highest tracking error, again, how it deviates from that benchmark, and then downside protection from the total fund, again, illustrated by those calendar year returns when equities do poorly. And then finally, for Loomis Sales Core Plus, again, strong long-term returns, both from an absolute, relative, and risk-adjusted perspective. But for the active managers under consideration, a bit higher fees than, say, Baird, even though they're a little bit lower than the current fund, that Loomis Sales Bond Fund. So with that, again, let me pause for a second. We have a rebalancing proposal later on where we'll be looking for more of a formal action. But before we get there and continue, happy to pause here and answer any other questions or comments that you all have.
So your recommendation is going to be to replace the Loomis Sales bond?
Yes, that's
And
correct.
then does Marquette have a recommendation of the selection?
Yes, I'm happy to talk about that now, or we can do it when we get to the specific rebalancing. It's up,
Oh, okay,
I'm okay putting it off.
okay,
okay,
okay.
Okay.
But I will address that, Ms. Pratt.
okay, okay, thank you.
Okay. Anything else before we continue? Okay. So if you skip ahead Exhibit 2, just a quick note on the U.S. equity structure. And again, these charts will look similar to you on page 16, but before we hit that, again, a brief review of what we were sort of working with and what we're working with now. So from a U.S. equity perspective, in that top bullet point, the previous benchmark was sort of a mismatch of a few, being the 73% to the S&P 500, which is mostly large cap stocks, but some mid cap stocks. 15% to the Russell 2500, which is both small and mid caps, and then finally 12% to the Russell 2000, which is all small caps. So in the new policy, and again, in an attempt to simplify that benchmark and make it, representative of the actual opportunity set, is the Russell 3000, which consists of all small, mid, and large cap stocks that were in the previous benchmark. But again, now we're just making it simplistic and saying, the benchmark is the broad market. We're not sort of mixing and matching things across small, mid cap, and large cap stocks. So with that said, on page 16, again, this is the same exercise that we looked at previously. At that time, we were comparing things to the current benchmark that I alluded to just a second ago. And if you recall, at that time, there was a huge sort of style bet. And we had, big underweight to value stocks, big underweight to core stocks, and a huge overweight to growth stocks back in January of last year. And then from a capitalization perspective or company size, there was a huge overweight to mid-cap stocks and an underweight to small-cap stocks. And obviously, we took actions to address those bets, if you will, at that time. But now that the policy's changed again, thought it would be prudent to take another look under the hood. So what you're seeing on the left here is essentially a weighted average of the U.S. equity managers and their exposures. This is akin to basically a Morningstar style box, if you're familiar with it. So across the top from left to right, that's equity style. So value stocks, which are cheaper, core stocks, which are essentially sort of down the middle, you can think of them, and then to the right, growth stocks, which typically trade at much higher valuations given the prospects for higher earnings growth. And then from top to bottom on the left, there's the company size, the large, mid, and the small. In the middle of that box are all the respective allocations, and then we sum them to the right and then below. So the left box is the total U.S. equity now, and then the right box is the policy. But the key takeaways are those bottom two rows under difference, and you can see in parentheticals actual minus policy. So from a style perspective to the left, there aren't big bets right now. A slight overweight to value being sourced from core and growth, and obviously you can see those numbers don't add to zero, it's just rounding. But the big thing to the right, or the big takeaway, is right now we have a huge underweight to large cap stocks, which is being sourced from a small allocation to mid, and a big overweight to small cap stocks. So if you think about that 9% to small caps and look at the box above it, specifically under total, where you see large, mid, small, as you work your way from top to bottom, the current market is only comprised of about 9% small caps. So if we have 9% more in small caps in the market, that essentially is a double the amount of small caps within the fund relative to the overall market. Now, there's certainly a case to be made for having more in small caps than the overall market. They do tend to outperform over the long term, but that's a really sizable bet by any stretch of the imagination. And the rebalancing proposal that we'll hit on in just a second really attempts to mitigate that bet or mitigate that tilt, bringing it more in line with the broad market. So again, let me pause for a quick second until we get to the specific rebalancing recommendation.
This is kind of like my wife who works at an elementary school. It's all fun till somebody starts crying.
I don't know how to respond to that, but,
So set
but
in-
your point is taken.
That's a set-in for not being too overweight where you
That's right, that's right.
want to be.
It's great when, yes,
While
yes,
it's
sir. It's
working.
great while it's working, but when it goes against you, and then to your point, Mr. Walters, that then it becomes an issue around behavioral risks, right? You know, when things are working, it's great, things are going well, but then when it doesn't work, that's exactly sort of the wrong time to do something, right? So this exercise is really trying to get ahead of that and lessen the risks of that happening. So with that said, unless there are any other questions, if you would please grab the next exhibit, and we'll get into the recommendations here on page 18. And there's a number of things that I want to bring the board up to date on, and as we work through the rebalancing, the impact, and other items around cash. So please bear with me for a couple minutes. But the first point I wanted to take, or wanted to bring to your attention, if you look at the very top row, the third column there where it says total assets of the fund as about a week ago are about 134 million. So that is down about $3.6 million since we met in November. The markets closed out the year pretty strong, but this year it's been a very different animal, as I'm sure most of you all well know. You know, the Federal Reserve has, as most investors use the word pivot, which I think is a generous term for how they've changed course rather quickly. If you recall last year, their sort of median outlook was that they were going to keep interest rates at zero through 2023. And that changed rather quickly in November as they started alluding to essentially tightening policy, so raising interest rates, stopping their quantitative easing program, or expanding the balance sheet. And when the minutes of their November meeting were released in January 5th, it was much more what's called hawkish than markets were expecting. In other words, the Fed was alluding to much more tightening than the markets were expecting. So not only increasing rates this year, but multiple rate hikes, maybe 3 or maybe even 4. I actually saw this morning on the way down that the market's pricing in maybe 5 rate hikes this year. And in addition to that, stopping their quantitative easing program and then moving into rather quickly a quantitative tightening. In other words, letting their balance sheet reduce, which is something they waited to do for quite a long time the last time they tried to do it. And again, I think we can chalk this up to them being a little bit behind the curve as it relates to inflation. And we'll speak more about that in our next meeting when we look at the performance. But that's really what's driven equity market weakness. Investors just becoming concerned about the Fed policy, what it's going to do to equity valuations, corporate profits, and maybe the economy as a whole, because a tightening policy generally leads to slower growth. So that, and I wanted to also bring to your attention before we get to the rebalancing, is really the regional allocations, namely the U.S. equity, developed non-U.S., and emerging market allocations. So that's in the column to the right of total assets. So if you look in the first gray column there under total U.S. equity, you see the current allocation is about 31.6%. And then all the way to the right in blue, the new target's 34%. So we're quite a bit underweight U.S. equities right now. And that underweight is really coming from the overweight in developed non-U.S. So the second gray bar, the one below total U.S. equities, there's about 18% there. And then if you look all the way to the right relative to a target of about 14%. And then the third grade bar, the emerging markets at about 5.3, all the way to the right to a target of 7. So this rebalancing proposal within equities is really meant to address a couple things. Number one, the large cap underweight and small cap overweight I alluded to a second ago, and some of these regional allocation differences. So with that said, let's walk through things from an equity perspective, and then we'll shift gears to fixed income. So specifically in the rebalancing column, we're proposing adding $7.5 million to the Vanguard Total Stock Market Index Fund. $4 million of that dollars, you can see in that same column in U.S. equities, would come from the small cap managers. So that would help us with two things. Again, addressing those large cap overweights large cap underweights and small cap overweights. Also, those two small cap managers are active managers, so they have expense ratios in the neighborhood of 85 to 90 basis points. So moving money into the index fund will bring down fees rather dramatically. And then it also will help us address those regional differences, because you can see under the last $2 million redemption, it would be $3.5 million going into U.S. equities, because as you can see below that 3.5, proposing money coming out of two of the international managers, namely Schroders and Prudential Fund, that's sub-advised by a firm called Genesim. And again, that would help us from the regional perspective and also have a positive fee impact, because again, those funds are active, so they have higher expense ratios, where most of that money would again go back in the Vanguard Total Stock Index. And then $1 million of that, if you look below the -4.5 in the total non-US, will also go into an index fund in emerging markets. So again, really tackling the differences in the weightings within the US, the regional differences, and also helping from a fee perspective, since the dollars are going into index funds. So when you sum those numbers, it nets out to zero. So we're not liquidating total equity investments. We're just, changing the structure of them, or I'm sorry, we're proposing that the board consider changing the structure of them. And that's really illustrated by the tables to the right there, where you see pre-rebalancing allocations and all the asset classes listed to the left, and the top one's equities. You can see the difference, it's just a slight underweight. But then the table below that, the post-rebalancing, again, the difference at the top for equities, it's the same number. So we're just moving money within equities, not taking money out of equities. Now, that's the equity proposal. If you look further down the rebalancing, you can see, again, the recommendation within fixed income to liquidate the Loomis Sales Bond Fund, adding that to a new manager, which would be about $200,000 or so higher. And we can source that number, or the additional $232,000 in gray there, from cash. So we're carrying a little bit more than $4 million in cash now. And if you remember, the reason behind that is because we knew we were going to need a sizable allocation here in Q1 with the drop payouts, right? So in October last year and November last year, when markets were ramping higher, I said, well, this is a good time. We know we're going to need this money in short order. Markets are good right now. Let's do it now and not wait, because we don't know what's going to happen in the 2 months before we meet again. So there were 3 drop payouts in January. And Ms. Pratson, please correct me if I'm wrong, but in April, we expect another $1.6 million in drop payouts. So we have about 3.8, or excuse me, we have about 4.1 now. And if we source that additional allocation of $230,000 to add to the new bond manager, we have well in excess, or almost 3 times, I'm not doing the math right, I'm sorry, about 2.5 times more than what we're going to need on April 1st. Right. And then again, I don't believe there are any expected drop payouts, at least for the remainder of this year.
Correct.
Is that correct? So again, we have what we need to fulfill those payouts. And like we talked about before, the fund is essentially slightly cash flow positive between the member and the county contributions, less the member benefits. So we don't think we're going to find ourselves in a position where we need to sell anything to fund any liquidity needs, at least for the next 9 months. And we'll continue to revisit the drop payouts as we continue to get those updated numbers.
I'm getting a little lost in the terminology. The drop is on the retirement side as opposed to calls on our private equity side, correct?
Mm-hmm.
Yes.
Do we have any calls coming up?
There are 2 calls coming up. There's one, the 27th, there's one tomorrow, and there's one on February 7th. But that will be funded, if you see Mr. Walters, under the cash and equivalence line, sort of all the way to the bottom there. So we show not only what's in, WF Wells Fargo, but that cash held outside Wells Fargo, that's what's at Morgan Stanley.
So we're not worried about
covering
the calls?
So that those funds are covered, they cover well in excess of what's coming up, and it's Thankfully, I don't remember, if you recall, Ms. Preston, the last time we had to wire money to Morgan Stanley, it's been quite a while because it's been self-funding. So we've been getting the distributions, and they've been enough to fund the calls, but, so we don't expect, they're just two outstanding, and they're well short of the $780,000 that are there. One other quick thing I wanted to mention, I know this is a lot, but there's a lot of pertinent items. Under fixed income, if you look all the way to the left, so you can see, total real assets there in the gray line, and then it shows fixed income. The first fund there, Blackstone Secured Lending Fund. So if you recall, around maybe May or June of last year, we talked about how one of the private credit funds, Blackstone, was going to undergo an initial public offering for the fund itself, and that did occur late last year in October. So right now, the value of that investment is about $1.7 million. So that's the shares that the fund owns, multiplied by the current market price, which is now traded daily. However, with any IPO, there's a lockup. So this is reflective of the current shares, but only a minimal amount of shares have actually been delivered to this point. Only about 10% of them have been delivered to the previous advisor. That's where they're going because that's where the fund was held. There'll be another delivery of shares on March 1st. Again, it's going to be more on the minimal side. The bulk of the shares are going to be delivered in May and then again in June. And that will be the final delivery of the shares. So when we meet again really in March, there might be a nominal allocation that we can consider doing something with, but right now it's basically nothing. But then as we work through the rest of the first half of this year, I believe we have a June meeting. At that point, all of those shares will have been delivered, and then we can take, or we'll recommend, and the board can take action as appropriate at that time. But I just wanted to bring you up to speed that it did undergo that IPO late last year, and that's what you see here. But we can't do anything about it because even though you own the shares, they haven't been delivered yet because of that post-IPO lockup.
Does the value reflect the total amount of shares?
Yes, it does, yes. Yeah, if we could do something with the 1.7, I would have definitely
But that's about going to be, assuming that it's the same value, that's what we have to play with in June about.
Correct, and we can revisit in March when we get that additional allocation, so we don't have to wait all the way till June, but right now it's so minimal, it's probably not worth the transaction cost. But we'll continue to update that value when we meet with you all, and I'll continue to update you on where things stand as the shares get delivered.
Okay.
So with all that said, before we get to the specific recommendation or, the summary as we laid out on page 18, again, on page 19, this is just a reprint of what I showed earlier. I just wanted to put it back in here. So if you look at that bottom right row there under difference of actual versus policy, again, the relative allocations of large, mid, and small there. And if you turn to page 20, you can see the impact of the rebalancing proposal here. So again, in the bottom right, for large caps, which was a 12% underweight, that moves down to 5%. Mid caps essentially stay the same, but importantly, that small cap underweight is dramatically reduced from a 9% overweight just to about a 2% overweight. So with all that said, if you look on page 21, this lays out the specific recommendations from the board that was outlined on page 18. So what I've done here, under the add and increase to the left, the $7.5 million to Vanguard total stock, you can see where that money would come from. We don't have a $7.5 million redemption, so the four items you see there essentially add up to 7.5. The $2 million each from the small cap funds, $3 million from one of the international funds, $500,000 from one of the international funds, and that additional $1 million from Prudential then would go to the Fidelity Emerging Markets Index. The other addition, as we discussed, $4 million to the new fixed income manager, which would come from the liquidation of Loomis, and also sourcing about $200,000 from cash. Now, before we get into the specific recommendations, let me again please pause for any questions or comments around that. Okay. So from our perspective, I think it'd be prudent for the board to consider really either Fidelity or Baird, because in isolation of the four managers I showed you, Baird would be our recommendation. But when we think about what else is in the fixed income portfolio, we already have a Core Plus manager, and we have another manager that has some allocation to high yield. So depending on whether the board wanted to go a more conservative route, that would be the index fund. But if the board is comfortable with, a little bit more risk, a Core Plus light approach, as I'd mentioned, which would also be higher fees than using the index, but lower fees than what you're paying now, then Baird would be the recommendation. So that's really the breakdown or the thought process, I think, is, what should be used in determining whether to use the index fund or Baird would be our recommendation. But again, I'm happy to pause here and answer any questions or comments.
Well, my comment is I'm happy trading a little bit of return off for knowing that we're doing something pure, that there's nothing else going on in there that we don't really understand, no matter what it adds to the return, which isn't all that much. And the costs aren't that much higher. But for what we're trying to do now, I think plain vanilla is the way to go. The
Meaning
Fidelity Fund. Pardon?
Meaning Fidelity?
Fidelity.
Well, and then we're going to have another 1.7 shortly in that sector, right? With the Blackstone, that you could do something.
Right, so when that's another good point. So right now, we're classifying that as fixed income, but
Right.
really what it is all, essentially sub-investment grade debt.
Right.
So at that point, it could be prudent to, go the route Mr. Walters is outlining, and then when we get those funds, either they could go to Fidelity or one of the other two managers.
Right, try Baird or whatever, right? Right.
Well, I'm going to move that everything on your page 21 for removal, we adopt that, and that we use the Fidelity Fund in the amount that you specified, 7.5, I believe it is, million.
Oh,
The fixed income.
Yes,
it would be
No, that would be
4 to
four.
4 million.
7.5 was the
Yes,
equity.
correct,
That's all
four.
right.
I'm sorry, 2 and 2.
Million here, million there.
Pretty soon it's real money. Thank you, Senator Dirksen. He was in the billions, I think.
Yes. Is there a second?
Second.
Do we need discussion?
No.
Okay. All in favor, vote aye.
Aye.
Any opposed? Ayes have it, motion carries. Thank you.
All right, thank you. So our last two sections, we will run through quickly here, just on the custody RFP update in the next section. Just for those of you on the board, not on the technical evaluation committee, as a quick update. So we did send out the RFP November? November. Time runs together these days. In November, we did receive 3 proposals, including the incumbent. The other 2 firms were, our firm knows well. They're very strong firms. They operate both in not just the Maryland County space, but also really the Mid-Atlantic County space. So the Technical Evaluation Committee reviewed the firms. 2 of them have been shortlisted. As you can see, the next bullet point, we are targeting presentations actually for the morning before the next SORP meeting. So at the meeting in the afternoon, we can provide a little bit more color, but either before or immediately after them, we'll also do the reference checks. So the presentations, the reference checks will also be incorporated into the scoring, and then eventually we'll open those cost proposals as the final piece of the puzzle. So things are continuing to move it on. The target date is still to have that award go through Q2, and then the transition will follow that. But it'll be important to be very thoughtful and deliberate about that transition because moving from one bank to another obviously takes some time. We want to make sure everything's done thoughtfully and deliberately so there's no hiccups. But that's where things stand. And again, happy to answer any questions or address any comments.
What date is the presentation?
The 24th, I think, is the date of our next meeting. So we're targeting 9:30 for the first one. We're going to give them an hour, 40 presentation, 20 Q&A. And then the second one at 10:45, and similar story, 40 minutes presentation, 20 minutes Q&A.
February 24th?
Yes.
Yes. Yeah. And we're hoping to have them in person. You know, I suspect that some of the firms may be under travel restrictions. So if one of them cannot make it, then we will do both of them virtually to try and keep an even playing field.
And the boards will be invited to attend, and it would be as observers,
Right.
you know, not as participating in the ranking.
Right.
So, and more to come on invitations, thank you. And there's, just to piggyback, the transition from Wells Fargo to Principal is still on track, and that is the weekend of President's Day. So that's coming up in February.
Okay.
Okay. So last section, last page on page number 25. Just next steps. As you all know, like to just give the board a heads up on what's coming down for the next subsequent meetings here. So the next meeting will have the Q4 performance report, any recommendations as appropriate, but similar to what we did today on the equity and fixed income side, you know, there are other asset classes within the fund right now that we'd like to get more in line with the current IPS. So at the next meeting, we're planning to bring a private open-end infrastructure manager search. So right now, the infrastructure allocation is via Cohen & Steers, a mutual fund that buys and sells the equities of companies that own and operate infrastructure assets. You know, per our education and how the policy is written, you know, we're big believers of using this private open-ended approach. So just as a quick background, you know, it's not nearly as illiquid as the private equity and private debt, but it's not traded daily. However, you also control the cash flows of when you put the money in and ask for it back. So that's very different than the private equity and debt. And you can do that relatively on a quarterly basis. But one of the benefits of that is, since it's private, it's not valued daily. In other words, you know, that it doesn't really have to tolerate the volatility of the equity market. So it's generally a smoother ride relative to an equity investment, which can be helpful from an actuarial perspective. You know, lower the volatility of the assets, more stable funded ratios, more stable contributions from a budgetary perspective. So we're planning to tackle that. Like I said, custody RFP updates, and then subsequent meetings, we'll do a similar exercise for real estate recommendations, custody RFP updates. And I know I've been talking about that last item there for quite a while now. You know, we've done a lot of work. Just, you know, we're headed in the right direction. I feel like, you know, there's a number of other things we still want to tackle and move along. And the custody RFP transition will take some time, but to the extent the board's still interested in the traditional versus OCIO services, happy to tackle that. But I would expect if we do, that would be in the back half of the year. So we can revisit about whether you all would like to, you know, have education around that. Just wanted to point out, we haven't forgotten about it, but, you know, other things that we think are important to handle first before we do that. So again, that wraps up my comments, but happy to answer any other additional questions or comments, because I did promise Mr. Weiskopf 2 o'clock, and I am bumping up against it.
Well, I'll give you the benefit of a short answer. We have 2 private open-ended things upcoming.
Yes, sir.
Doesn't that put us back where we were about having a delayed ability to value them because of the essence of getting a value?
Actually, it wouldn't affect our report. So with the private equity and private debt, as you know, so when we do the Q4 report, we'll be using September 30th values. Those investments, we would get those statements within the first month of the quarter. So when we do our reports in the middle months, we will have the updated values as of the end of the year, like all the other investments that aren't private equity and private debt, because they are semi-liquid, not completely illiquid like the private equity and debt. So they would be updated. The only things that wouldn't be would be what's not updated now.
Okay. Thank you.
You're welcome.
Thank you. And that would bring us up to old business. Ms. Bratson?
Oh, thank you. Truly, this is just an admin item. We, at the last meeting, approved the investment policy statement, and I attached it to the board doc just so we have it for reference in the future, and it's the signed document.
Great.
So if anyone wanted to reference it or use it or see it, it's out there.
Great, thank you. And next would be the administrator's report by Ms. Smith.
Okay, so the total for the administrative report is $47,268.06. That includes 5 retirements, 1 transfer of pension contributions, 2 refunds, the annual portal maintenance fee, and the annual participation fee. We had 211 participants. And the other invoice that we have was for Marquette Associates, their investment consulting services, for the period of July 1st of 2021 to September 30th of 2021 for $29,703.06, for a grand total of $47,268.06.
Thank you.
We need to move it accept as a document.
Yes.
Yes.
I will
Move to
entertain a motion.
accept as presented.
Second.
I have a first and a second. All in favor, say aye.
Aye.
Aye. Any opposed? Ayes have it. Thank you. Is that the end of the administrator's report? Mr. Smith, thank you. Next would be public comments. I do not see anyone in the room. So with that, I will look for a motion to adjourn.
Move we adjourn.
Second.
All in favor, say aye.
Aye.
Aye. Ayes have it. Motion carries. Thank you, sir.